Good evening, everyone, and wish you all a very happy new year. Welcome to the Market Insight on Fixed Income by UTI Mutual Fund. We have Mr. Anurag Mittal, Head of Fixed Income, and I am Sandeep Solanki from Products team. We, we will go through the detailed market insight on fixed income, where Mr. Anurag Mittal will cover domestic and global trends, followed by the Q&A session. Feel free to add your questions during the webinar and we'll address them at the end. Over to you, Anurag.
Thank you, Sandeep, and wishing everyone a very happy new year. And may this new year be very prosperous and healthy for all of you. What a year it has been. So, in fact, when we started 2025, we termed it that probably it will be a year of chaos, and probably it was, starting with the various tariffs announcement on the Liberation Day and the whole roller coaster the equity and both bond markets have seen throughout the year, with application of tariffs going all the way up to 130% of China before China and US agreeing on a deal, which makes it effectively 30% approximately on China. And when the year started, it was assumed that probably India and US will be in a very sweet trade deal. And as things stand today, things have turned slightly adverse as India and US are still negotiating a bilateral and a mutually beneficial trade deal. But apart from the various issues on trade front, it was also a year of strong growth, despite observations in the early part of the year that because of uncertainty on trade and tariffs, probably growth will take a knock and central banks will have to cut aggressively. Central banks did cut, but not as aggressive as many participants were hoping for in the beginning of the year, as growth continued to be resilient thanks to high fiscal spending by governments across the world. And and that's why probably bond market staying range bound despite the rate cuts, whereas while the monetary policy is, the fiscal continues to be aggressive, and that has led to steepening of the yield curves uh, across the world. So largely in this webinar, we'll be discussing the key trends facing market today and what are the implications for our portfolios. So starting with the global trends, if we look at the chart of the left-hand side, which is the JP Morgan global PMI on both manufacturing and services. The blue line is the manufacturing PMI and the orange line is the services PMI. We are seeing some signs of moderation in activity, although overall economic activity remains in expansion, as any reading above 50 is considered expansion. And where is the moderation coming from? So the moderation is largely coming on the manufacturing side in the US and Eurozone in the last couple of months, because as while for the first half of the calendar year, manufacturing activity was quite strong, it remained strong across sectors, and especially driven by the AI related spending which is happening. So AI is not just now a technological breakthrough, but spending is happening across data centers, chip designs, uh, grid production, etc., etc. And in fact, as per some expert estimates, about 7 trillion will be invested across AI and AI related investments in the next 3 to 4 years. So huge investments coming up. So manufacturing should continue to remain resilient, but broadly, there was some slowdown in the last couple of months in the US and Eurozone. But like you're talking about AI, if you look at the impact of AI related spending, and if you look at the manufacturing in China, Korea, Taiwan, which have been one of the main exporters of semiconductor related stuff, that has been quite strong. So the moderation in the US and Eurozone was offset by strong activity in China, Korea, and Taiwan, where they continue to receive strong domestic orders as well as high export orders as well. If you look at the economic activity surprise index, which is the actual economic activity compared to consensus expectations. If you look at an eurozone, which is the again the orange line, there has been a consistent and a sharp decline since the beginning of the year. So, in the beginning of the year, when Germany and some of the other large countries in the eurozone announced high fiscal stimulus, there was an anticipation that probably now manufacturing will pick up, capex will pick up, it will lead to high economic activity in Europe. But apart from the initial burst, now that's moderating and that's largely reflecting in the data. While in the US, it's slightly below in the September numbers, but still it remains above consensus. So overall economic activity in the US, especially driven by capex, continues to be quite strong. If you look at commodity prices, this year has been very strong for commodity prices. Bloomberg Commodity Index has increased by about 12% YOY, despite almost a 20% fall in crude oil prices. Large drivers of the rally in commodity prices, as we all know, probably is precious metals. So both gold and silver have really done well this year, with gold registering gains of more than 50% and silver more than 100% in this calendar year. So broadly, they have offset the decline in crude oil, and copper has also continued to rally due to slightly supply tightness and also strong support from AI-related, capex spending. Of course, precious metals continue to be well bid across central banks and other economic participants given the geopolitical frictions, and hence we are seeing a trend of diversification among central banks to add more gold to their FX portfolio. If you look at the food prices, while food prices continue to decline YOY, there was a broad-based decline in meat, dairy, and sugar prices due to heavy supply. There was a slight uptick in cereals because of some near-term supply side distortion, but overall, food prices continue to remain moderate. Going ahead as well, we expect food prices, especially the cereal, uh, dairy prices, to remain stable. Of course, in India, vegetable prices have started to inch up, uh, but it's still too early to say whether it's a long-term trend and how things are expected to be about. But largely, it's all well under control as far as food prices are concerned. We had the December FOMC meeting where the Fed cut rates as expected to 3.5-3.75 range, citing increase in downside risk to employment and uncertainty about the economic outlook. They did, while inflation continues to be above 2%, Fed mentioned that probably the downside risk to slow down in economic activity have increased, and that's why they are cutting interest rates. As far as the dot plots, which represent the median view of all the FOMC members, that indicate only one rate cut ahead in 2026. So broadly, so that's largely unchanged from the previous projections as well. So nothing material. If you look at the market consensus, so there was a time in October and November when probably the market was thinking that inflation will come down and growth will also slow down, and probably Fed will have to cut 3 to 4 times in this calendar year. But today, even the market participants are not very away from the Fed, and the market participants are broadly expecting 50 basis rate cut from the Fed this year and probably 25 basis. So not material difference between the Fed and the bond market as evidenced by swaps. The main reason is the high fiscal deficit. We have the one big beautiful bill which will come this year. There will be fiscal benefits to consumption as well as investment. So broadly, the bond market expects growth to remain strong this year as well, thus removing too many rate cut expectations that the market was carrying in September and October. Apart from other notable things, apart from the monetary policy, the Fed also announced the restart of their bond buying program, where they said that they will buy short-term treasury securities to infuse market liquidity, and that will be about $40 billion of treasury bills every month. So if you look at the Fed balance sheet, which is a chart on the right-hand side, as a percentage of GDP, before COVID, the Fed balance sheet was about 20% of GDP, which swelled all the way to 35% as Fed bought assets very aggressively during COVID. And as Fed, continued to run off its balance sheet, post the COVID normalization, if you would see, now it's almost come back to a 20% level, which was pre-COVID. And at the same time, liquidity in the system is tightening in the US. And since Fed is an accommodative phase where they're cutting rates, it was rightfully seen by Fed to start, their balance sheet expansion, which will increase liquidity. But if you look at the nuance, the Fed is increasing its balance sheet through treasury bills rather than through dated securities. So it's buying short-term T-bills, which will keep short-end yields in check, which will increase liquidity, but the long end will still continue to be driven by long-term inflation and fiscal expectations. So this is how the major bond markets behaved in the month of December. So if you see across the world, probably apart from Indonesia, we saw uptick in bond yields. If you look at US, bond yields rose by 15 basis points. Germany, similar 17 basis points. Japan, Australia, 25, almost 25 basis. India, about 8 basis. The reason was, like I said, probably in the starting of the second half of last calendar year, the bond market was anticipating that as the effect of tariffs will come on the price of goods, consumption will take a hit because of uncertainty. Probably the employment market will be in worse shape, and there could be some job losses, and global growth could take a hit. But you know, because of all the renegotiations on tariffs and because of all the exemptions, the actual hit on the tariffs was not very meaningful as it was feared in the beginning of the year. And a large part of the imports in the US were already front loaded in the anticipation. So probably the impact on inflation or on growth was not as negative as the market was fearing after the Liberation Day. And as markets slowly started to realize, that's when largely the market started to reprice as well. That probably central banks will not cut rates as aggressively as many market participants were thinking in the beginning of the year. In fact, in Australia, they had to hike rates because inflation and both growth outlook have become quite strong. In Japan, they're talking about rate hikes as well. They have been hiking rates. They're probably on a hike in the next policy as well. So both, we are seeing divergence where US and eurozone are still in the rate cut situation. They're cutting rates, and whereas you have developed economies in Asia Pacific, which is also reflecting strong demand in real estate, strong labor market, strong export growth due to semiconductor demand. Uh, so that is also resulting in higher bond yields in Asia Pac, despite fiscal deficits not being very high as we are seeing in the rest of the world. Now coming to financial conditions. So broadly, if you look at financial conditions, so a positive number or a upward sloping curve means loosening financial conditions, and a downward sloping curve means tightening financial conditions. So if you look at the expectations of the market, broadly, while the US treasuries have risen in terms of yields, but if you look at the equity markets as well as the credit market, that has done quite well. The spreads have tightened in the credit market. Equity markets have continued to remain buoyant due to expectations of benefit of AI-related productivity, and that's why we are seeing ease of financial conditions in December as well. Now coming to domestic trends. So, I was talking about food prices in my early part of the discussion. So, if you look at various the sowing update for the Rabi season, apart from rice, largely sowing has been behaving quite well. If you look at the wheat acreage, it's about 107% of the normal. If you look at pulses, it's 95% while the season is still going on. So probably by the end of the season, pulse sowing will be also quite high. If you look at oil seeds, that's very, very encouraging. That's already 111%. So rice sowing, while it may look that it's only 41% of normal sowing area, but like I said, the season is still ongoing. and probably by the end of the season it should normalize. But because if you look at the YOY numbers, the sowing of rice is up about 17% YOY. So overall, it's doing quite well. If you look at the reservoir levels, because that's also very important consideration, especially if the monsoon ahead in 2026 is volatile, at that point of time, it's the reservoir levels which help the farmers to grow and harvest the crops well. And if you look at most of the regions, whether it's northern, eastern, central, or south, most of the regions are at in line or in fact higher than their previous year or their long period average. So for example, North region, if you see, the previous year was just 45% of total storage capacity. This year it's 72%. So a lot of leeway there, a lot of headroom there. If you look at the typical average storage capacity for the last 10 years, it's been 54%. If you look at the eastern region, it's almost in line. Western region again continues to be comfortable. Central region again much higher than previous year and long period average. And if you look at the southern region, it's slightly marginally below the previous year, but well above the long period average there. So broadly overall, even the reservoir level continues to be quite healthy, which gives us certain buffers in case of any volatility experienced in monsoon in the second half of 2026. If you look at the trade deficit numbers, of course, we talked about how gold and silver prices have behaved this year. It's led to very strong gold demand in India, and especially in the month of October. We saw a very sharp spike in trade deficit. So if you remember, in October, the trade deficit widened from 33 billion to 42 billion because of very, very high gold imports. If you see that in October, the gold imports went from 9.6 billion in September to 14.7 billion. That was also related to festival related and wedding season related demand. But as we see in the subsequent month, which is in the month of November, the trade deficit has materially improved. If you look at gold imports, they have come down from $14.7 billion to just $4 billion. So overall, a very sharp reduction in gold imports, which has led to a material benefit in trade balance. Even if you look at non-oil service exports, they also rose by about $3.8 billion, led by engineering goods. In fact, if you look at post the tariffs, especially the penalty tariffs of 25% in the month of August, we saw exports to the US declining by 10% in September, October. Probably one reason was also the front loadings, because as exporters feared the additional tariffs, they shipped most of their near-term exports in the month of August itself. But yes, we did see fall of 10% in September, October. If you look at November, again the exports to the US have picked up, and now they were 23% up YOY. So, but in a nutshell, what does it mean for INR? So, of course, one of the key questions that many of the market participants as well as investors have regarding INR, that's already 90, where it can go. We had discussed this in the previous presentation. Also, from a valuation perspective, INR has become quite attractively valued if you compare to its previous trend across major currencies. So, from a relative currency valuation perspective, it's become attractively valued. It's a sentiment, it's because of certain outflows that equity markets are seeing, which is leading to INR underperformance. So, probably once capital flows stabilize, once there is also stability or a truce India in the India-US deal, we should see more stability and some appreciation in the INR as well. If you look at fiscal deficit, so this is the fifth month in the last 6 months where receipts of the central government have declined. So if you look at the net tax revenue, it declined to 13,939 lakh crores compared to 14 lakh crores in 2025. So it's about a 3% decline. And one of the main reasons is decline in taxes. So we know that in the budget, the government announced some benefits on the income tax, and recently they have also announced cuts on the GST rates. So broadly, they are seeing lower tax growth. Also this year, the nominal GDP is expected to be 8% compared to the budget estimate of 10.5% due to lower inflation. So typically, tax points, your tax collections is a function of nominal GDP. Just to understand in a different perspective, for example, if your revenue last year was 100 rupees and this year the revenue becomes 110, your profitability or whatever you're saving is also a function of that incremental 10 rupees. So in a way, nominal GDP is a sum total of all activity done in a particular country, and hence at that because of inflation, as that nominal activity moderates, the tax collections on that activity is also moderating. So it's a function of tax cuts as well as nominal GDP slowdown, which is leading to this slowdown in tax revenue. But we do expect government to meet its fiscal deficit target despite capital spending. So if you look at capital spending, it's growing at 28% YOY. It's already at 6.6 lakh crores. Probably, we think that government will be able to meet its capex target for this year. Probably they will talk about rationalizing expenses in many schemes. There's already talks that government is planning to rationalize some of its schemes which are overlapping, which will save its revenue. So probably we'll see some cut down in revenue spending, and we are quite confident that the government will be able to meet its fiscal deficit target. So I talked about how the government is planning to rationalize its spending. So one of the examples of this rationalization in spending is how the government has reoriented Manrega, which is the Mahatma Gandhi National Rural Employment Guarantee Act, to Viksit Bharat Guarantee for Rozgar and Ajivika Mission. So while it looks like a name change, it's not. So if you look at, in fact, the government has increased the employment guarantee from 100 days to 125 days. But one of the major factors of the cost, which is wages on material, administrative, etc., now will be shared between 60-40 between the center and states. So, and also center will prescribe an annual allocation for states, and beyond that allocation, any additional spending will have to be done by the state themselves. So it will reduce a particular spending by the center. So in fact, it's expected that the new scheme will save center about 15 to 20,000 crores yearly. So if you look at various states, every state, what they are spending under Manrega and what they will be spending under the Viksit Bharat Guarantee Program for Rozgar, that spending will be slightly higher in the new program. And hence, every extra spending done by the states is kind of a saving for the center. So that's why this is just one example, but we do think that that's what basically is defining the philosophy of the government. Government is looking at rationalization of savings and to ensure that there is fiscal consolidation, and hence we do expect more such policies to ensure that revenue is fairly distributed from center and states, and at the same time center is able to reduce its spending. We also had the SDL borrowing calendar, which was announced. So SDL borrowing calendar was announced at 5 lakh crores, which was slightly above market expectation of 4.2 to 4.5 lakh crores. But there's a very interesting trend if you look at this chart. So the dotted line, or the dots in the chart on the left-hand side represent the indicative calendar, which gets announced every quarter, and the actual borrowing. So if you look at the actual borrowing, it has been typically lower than the indicative calendar, because as states also try to adhere to the fiscal deficit, they end up borrowing less. So probably if you assume a 3% fiscal deficit, which has been most of the states have been following, the actual borrowing could be close to 4.5 lakh crores rather than 5 lakh crores. That's something which the market will be anticipating, which the market will be keenly observing, and any reduction in the SDL may lead to some compression between SDL and government bonds, and also between long bonds and SDL, because typically the investors of long SDLs and long bonds are the same. So as the SDL supply comes down, they will prefer to take more position in the long central government bonds, which should look to see some spread compression. One of the reasons why the calendar has been higher than anticipated is many states have tried to bunch up their borrowing in the fourth quarter as they got more clarity on their cash flows. So for example, if you see the state of Karnataka, out of total borrowing of 105 lakh crores, 93,000 crores has been done in the last quarter. If you look at Chhattisgarh, out of total borrowing of 35,000 crores, 24,000 crores is being done in the last quarter. If you look at West Bengal again, 50% of total borrowing of the year, 85,000 crores against full borrowing, 46,000 crores has been done in the last quarter. So because of this last quarter bunching up, that's why we are seeing this kind of number. But we do expect that probably the capacity to borrow and spend for many of the states could be limited. So probably states may stick to 3% of the fiscal deficit numbers. So that's largely how we are thinking about. But in fact, just one interesting tidbit. If you look at Gujarat, so Gujarat had planned about 66,000 crores of borrowing, and they will actually end up doing borrowing of 48,000 crores. So Gujarat is an outlier. So just like many states are borrowing more than expected, in fact, in case of Gujarat, the borrowing has been less than expected because of sharp tax revenue. On the credit momentum remains quite strong. So one of the key focus areas of the new governor has been, removing impediments to growth and supporting credit growth for the banking system. And now that's been showing for the last, 3-4 months. If you look at the non-food credit, that increased to 11.8% compared to 11.3% in November. But if you look at the deposit growth, that was just 9.4 compared to 10.2 in November. So the system loan to deposit ratio is 81.6. So banks are running lower amount of government bonds, and they're focusing more for every 100 rupees of deposits. They are, giving more on the credit side and more on the lending side. And that's been the focus area of the government as well as of the RBI to ensure that the productive needs of the economy are met by the banking system. And that's where the focus is. But what it means for the market is as this gap which is there between the credit and deposit, that will have to be filled from somewhere, right? So what is happening is banks are aggressively issuing money market instrument like CDs quite aggressively. So 1 year CD almost has gone to 6.9% from 6.7% in December. So as banks grow their balance sheets, give credits aggressively, they will also be raising deposits aggressively in the market, and that provides us some opportunity also, because if we have a 3 to 6 month horizon, given the spike in yields, we can benefit from the normalization of those yields as we move into the next quarter. If you look at the sector-wise credit growth, largely, there was some seasonal moderation where, industries growth went from 10% to 9.6% in November. Infra growth went from 4.3 from 4.6. And if you look at services growth also, that also moderate. Of course, these are November numbers. As the sector-wise credit deployment comes with a further 1 month lag, in December, we might see uptick, because as the credit growth picked up in December, we should see uptick in many of these sectors in December. If you look at the yield curve, which is represented by the green line, largely we can see the yield curve continues at the 1 year AAA segment. We are seeing opportunities in the AAA space as well. Even if you look at 3 year, that moved from 6.7 to 7%. So, and the levels are further up from these month-end levels. So probably a good opportunity for patient investors to look at 1 to 3 year categories. But that's because as the funding rate is still 5 quarters. So remember, as liquidity improves in the banking system in the next 3-4 months, given the funding rate is quite low, we should see some mark-to-market benefit in the 1 to 3 year space as well. So largely on the outlook continues to be the same. We think we are at the end of the rate cut cycle, barring any economic shock, but RBI will continue to be growth supportive. They are likely to keep rates lower for longer. They are likely, to maintain easy liquidity. In this kind of a situation where inflation is stable, growth momentum is slightly slowing, but RBI, is keeping liquidity easy. We think the best segment is the short to moderate duration, which is typically the 1 to 3 year, and that's what we like, because there is a certain steepness in the curve, and that probably can lead to some benefit as the segment rolls down. We are also looking at selective accrual strategies in well-managed NBFCs and corporate, because as the rate cut cycle kind of matures now, the focus will move towards accrual, where people will be looking at absolute levels where products are stable and they're not too sensitive to interest rates. Of course, we are cautious on long duration. Like I said, we think given the supply expected in the next couple of years, especially when rate cut cycle is over, long durations may underperform the short to medium end. So broadly, from a asset allocation, from a time horizon standpoint, investors looking at a 3 to 12 month investment horizon can consider money market or low duration strategies. Investors who are looking at more than 12 months can consider short term to corporate bond funds, and investors who have more than 2 years investment horizon can look at income plus arbitrage category because that can give better tax efficient returns to the investors. That's largely, I'll stop there and we open the floor to questions. Thank you.
Thank you, Anurag, for sharing the detailed insights. I'm sure this has been a very good value add for our viewers. So let us begin with the Q&A session. So the first question is, looking ahead to 2026, which macro variable do you believe will be the most critical for fixed income markets?
I think the best of monetary easing is behind us. So for the last 2 years, the biggest variable or the biggest discussion point for market investors was how much will RBI cut, when will it cut, what will be the OMO, etc., etc. I think the largest macro variable in the next year at least uh, will be fiscal, because as the government is now from this year, the government is moving from fiscal deficit targeting to debt to GDP targeting. Given that a GDP is expected to grow around 10% and beyond, uh, we, uh, we, we do not expect material consolidation this year. And given the elevated demand and supply, it will need to be seen how much support can RBI provide through OMO. But even apart from OMO, I think there will need to be strong demand uh, for bonds, and hence uh, we that's why we are more constructive on the short to medium end. And like I said, we are more constructive on the 1 to 3 year because the fiscal variable is quite uncertain for this year.
Okay, thank you. So the next question is, with now most of the rate cut cycle behind us, how do you see the role of monetary policy evolving over the next year?
Right. No, that's a very important question because, like you rightly said, most of the rate cuts are done. But we believe, I think the role of monetary policy this year has to separate, the noise from the readings. Uh, because for most part of the year in fiscal year 2026,
Mhm.
inflation has been well below their target of 4%. In fact, RBI expects inflation to average around 2% for FY26. But if you're coming for FY27, there will be a base effect as well because of the low inflation this year. There will be slightly higher inflation next year because of the base effect, and also there will be a new CPI series. So the government is also changing the CPI series from February, and it will have new updations. It will have new items like e-commerce, etc. The methodology for many collection of various variables will also change. So probably RBI will have to see, to be honest, because the previous trends will not be there for this inflation series as mature as this inflation series have become. So probably RBI will have to take the uptick in inflation in the second half of this calendar year with a slight pinch of salt, and probably they will have to maintain steady policy. So I think the best the way RBI can do this year is focus on maintaining rates lower for longer, keeping liquidity easy, making their FX policy transparent, as they have always been. So I think that's largely what we expect from RBI this year.
Okay, thank you. So the next question is, given the extent of real effective exchange rate depreciation already witnessed, how are you assessing the rupee valuation and forward risks?
Right. I think given the tariff impact that India has seen in the last 4 months from the US, unless and until there is a major impact on services, which will be incremental. And now, whether the tariff on India is 50% or 70% or something, it's slightly immaterial because, I mean, we're still quite heavily taxed compared to the rest of the world,
Hmm.
especially other Asian countries which are taxed at 20%. So broadly, our competitive advantage is really not there compared to rest of Asia as far as the US is concerned at current tariff levels. So, so broadly, I think market has largely discounted that uh, loss of trade. So, given the significant correction that rupee has seen, in fact, if you compare to the dollar, the corrections, seems more muted. But if you compare it to other currency like euro, yen, RMB, the correction is quite meaningful. And hence, we think that, uh, you know, from these levels, probably we should not see a material depreciation, like I said, barring economic shock. So we should see rupee probably more in range bound manner this year. At least as things stand today, we expect rupee to remain in the range between 89.5 to 91, at least
Mm.
for the next couple of months. So we do expect rupee to remain stable. And probably at some point of time, once the dust settles, once there is a trade deal in place between India and the US, probably rupee should start outperforming other Asian currencies as well.
Thank you, Anurag. So the next question is from Mr. Ravi Sehgal. He has asked that there are few defaults in last decade or so in the fixed income markets we have seen by some of the institutions. So from an investor's perspective who have invested in the fixed income funds, how do you see the way forward?
So if you look at many of these credit issues which happened in the industry, those mostly happened in 2019-20, which also coincided with a very, very strong and a rapid growth in the credit fund industry between 2017 till 2019. So the industry, in a way, more than tripled during that point of time.
Mm.
And because of the excess growth, at that point of time, and especially as course the slowdown came uh, even before COVID, there was some issues in some of the credit papers. But if you look at in the last 6 years, uh, I think despite all the geopolitical disruptions, despite all the inflation or the growth disruptions, mutual fund industries portfolios have been quite stable, quite disciplined. Uh, like the growth has been quite steady. So of course, you can never rule out credit situation in the future. But largely, if you look at uh, the way mutual funds are focused today, most of the allocation is also towards high credit quality strategies. Uh, and I think whether you look at from liquidity perspective, from a duration band, and sector diversification, most of the funds are quite well managed. I would say the last 5 6 years. Uh,
Mm.
so I don't really foresee a credit challenge. But having said that, see, if you are a debt investor, one of the key variables that an investor looks when they are investing in debt is stability and predictability. So we always recommend our investors when they're investing in debt to invest bulk of their allocation in high quality products, irrespective of the market, irrespective of the fund manager fee. So as long as the allocation is correct, probably our experience from fixed income will also be more smooth, more positive during the course of our allocation.
Thank you. So the next question is from Mr. Manpreet Singh Gandhi. Uh, why there is a fall on the higher end of the yield curve? And what's your view on the longer duration funds?
No, that's a very important question. See, one of the reasons why long end has seen this correction in the last 6 months has, and we have been talking about this in our previous, webinars and other communication as well, that now we are coming close to the rate cut cycle. So if you look at how the rates have behaved in the last 2 years, most of the rally in rates happened actually before the rate cuts because the market was expecting rate cuts this year. And if you look at the 10-year or the 30-year or any part of the curve, they already rallied between 2024 to probably end of 2025. But this year, as the rate cuts, have happened, largely they are on expected lines. So market always works on, surprise compared to the expectation. So largely market was expecting 100 to 125 basis of rate cuts. Largely RBI has delivered on those lines. The second aspect why the curves are steepening and why the long end has underperforming is the supply issue. Because as while the rate cuts have happened, there are also some structural changes happening in asset allocation patterns. So, for example, if you look at pension funds, they are one of the largest buyers of long end government bonds. But because of the change in asset allocation pattern of the pension funds from 15% equity to 25%, uh, a large part of their allocation, which was towards government bonds and long end bonds, that's now moving towards equity. So that's also one of the reasons why the demand for long and government bonds is slowed down. So one side you have the end of rate cut cycle. On the other hand, you have the demand for government bonds, which is also slowing down. So if you put both these two together, uh, probably that will also help explain. The second point is, when the long end supply was really envisaged, and especially if you see the trajectory of long end supply, typically long end borrowing by especially by states used to be about 20%. That increased all the way to 55% till last year. Now it is coming down. One of the reasons was very high growth experienced by insurance industry in 2001, 22, 2023, which led to very strong demand for insurance sector as well for long end bonds. But there were, two reasons for insurance demand. One, of course, was favorable tax regime, and the second was very high savings rate during COVID. So as there was very high savings during COVID, there was a lot of that savings got directed towards financial assets like mutual funds and insurance, and especially that insurance money got directed towards long end bonds. So as that savings has again been focusing more on equities, whether it's direct equity, mutual fund, or insurance, as fixed income allocation is going down, that's also resulting in a slowdown in demand from insurance companies as well in long end bonds. So basically, to put in a nutshell, a slower demand from NPS and insurance, uh, plus the end of rate cut cycle has led to this correction. What does it mean for future? In future also, like I said, nothing is changing for the long end bond. So again, the slowdown in demand continues from insurance and NPS. Rate cut cycle is largely over. So probably curves will continue to be steep. There could be tactical opportunity because of market dislocations, but that, like I said, that as the name suggests, those will be tactical short-term opportunity. We don't see any major trade in the long end segment.
Thank you, Anurag. So the next question is from Mr. Vinod Homkar. What is your view on probable inclusion of fully accessible route Indian government bonds in the Bloomberg Global Aggregate Index and its implication in short and long term in the fixed income markets?
Right. So if you look at India is already included in Bloomberg EM index. So there is a high probability that in the next review, India also gets included in the Bloomberg Aggregate Index. The implication from a portfolio will be that about uh, almost 1.8 to $2 trillion worth of assets under management track that index. And if you assume our India market cap weight of 0.8 to 1%, that almost implies a $20 billion worth of inflow because of the inclusion. Having said that, a lot of that assets under management is actively managed.
Mm.
So they are not under any obligation to add India just because Bloomberg has added India into the index. So unless and until they feel that the demand supply dynamics, the fiscal dynamics, or the monetary dynamics are favorable for India, they may or may not decide to invest fully as per the index. Of course, they can go up over the index as well. So we should not straight away assume a $20 billion of flows into Indian bonds just because of the index inclusion. While we do expect some flows, so probably in the excess of $10 billion if the index inclusion were to come, but given the high borrowing program, we don't think it will lead to a material impact on the yield curve.
Okay. We'll take one last question. Now, if you had to articulate your fixed income strategy for 2026 in one sentence for the investors with the 1 year plus investment horizon, what would it be?
In one sentence, it will be focus on the short end of the yield curve because rates are lower for longer. So if you are investing for more than 1 year, a short term on a corporate bond fund is most suitable. If you are investing for more than 2 years, income plus arbitrage fund is most suitable.
All right. Thank you, Anurag, for sharing the detailed insights and answering all the questions of the viewers. We hope that Anurag's perspectives offered valuable insights into the fixed income space and the road ahead. We look forward to connecting you again. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.